Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Welberg, and I'm pleased to welcome a couple of alumni to the show today. Olivier Fines, CFA Institute's head of advocacy and capital markets policy research for EMEA, and Mark Higgins, author of Investing in U.S. Financial History, Understanding the Past to Forecast the Future. The topic of today's episode is a CFA Research and Policy Center report that Olivier co-authored titled The Dollar's Exorbitant Privilege, CFA Institute Global Survey on the U.S. Debt and the Role of the U.S. Dollar. I'm looking forward to hearing both about the findings of the Institute survey as well as what we can learn from history in thinking about the future of both the U.S. debt and its effect on the U.S.'s role as the global reserve currency. So welcome to the show, guys.
Thank you very much.
Yeah, thank you for having us.
So maybe it would be a good idea, I think, to just start with a definition today, because given our discussion today centers around the sustainability of U.S. debt and the impact it may have on the U.S. dollar's role as the global reserve currency. Olivier, maybe you could start us off by just talking about what does it mean to be the global reserve currency?
Right. Well, that is obviously the right question to start this discussion with. In general, we refer to the term reserve as essentially the reserves held by central banks around the world, right? So, and the purpose for holding reserves is a mechanism to stabilize or orientate the value of your own jurisdiction's currency by selling and buying currencies against your own. So if I want to orientate the value of my currency higher, I would essentially buy my currency and sell other countries' currency. For that to work, I need to hold reserves in order to effectuate those foreign exchange transactions. So essentially, we're talking about central bank reserves. And for a long time now, the dollar has constituted the largest part of central bank reserves around the world.
So having those U.S. dollars in reserve for all of these countries around the world, what's the impact of that on U.S. economy, industry, the strength of the U.S. dollar?
Well, that is one of the points that we make in the report. It's actually the origin of the problem, which is why we call the report the dollar's exorbitant privilege, which is actually a term coined back in the 60s and the 70s under the Bretton Woods system, which is that because the Bretton Woods meant that the dollar was convertible in gold, it conferred to the dollar an enormous privilege of essentially having the rest of the world fund its endless deficits because they had themselves to held dollars in their coffers. The funny development, at least from my perspective, and this is where a Mark could also bring in his historical perspective, is that even after Bretton Woods stopped, the dollar continued to enjoy its exorbitant privilege, whereby the rest of the world continues to buy U.S. debt, thereby conferring the U.S. the privilege of having the capacity to fund its deficit at very low interest rates. That's what we mean by the privilege conferred to the dollar. And it could be interesting to hear Mark on that concept. He might have a different perspective on this.
No, I mean, I think that's pretty accurate. We'll get into some of the history of the debt specifically, but that's pretty accurate. I mean, the U.S. became the dominant reserve currency after World War II and under the Bretton Woods Agreement, and has really been the dominant since.
So with the cheap financing and the world helping facilitate that, obviously it seems like the U.S. has gotten somewhat addicted to deficits and debt accumulation. So these are kind of the twin focuses of the report, which is what maybe I'll get you to talk us through it a bit, Olivier, but just at a high level, you surveyed a few thousand market maker people in our industry about their views on the sustainability of U.S. debt levels, what the government might do to tackle those if it's a problem, and then also their view on the sustainability of the U.S. dollar as a continued global reserve currency. So maybe you could talk us through a bit on the findings in the survey and report.
Well, we approached this work probably a year ago from the concept that we refer to as de-dollarization, which is an elusive trend that people have been talking about now for decades. And probably since the end of Bretton Woods, the idea has been, well, with the dollar no longer being convertible in gold, if the US continues to run such aggravated levels of deficits, this should normally, and I'm going to use these terms carefully, normally lead to a depreciation in the desirability to hold dollars. Okay, and we have not seen such an effect on trends since the dollar has continued to enjoy uh, a preponderant importance in transactions, in foreign exchange flows. It continues to be the dominant reserve currency. It continues to be the dominant form to denominate funding, whether it's debt or equity. So we haven't seen the supposed effect on the dollar from the U.S. public finances getting worsening actually over the years. So we did this survey and this research, which we wanted to publish before the U.S. presidential election back in November, precisely because we thought this topic should be front of mind of main policymakers in the region, as opposed to continuing to be an elusive concept. We thought it should be right at the core of policy decisions for the next administration. It is interesting that since we've released this, I'm not going to say it's directly the effect from our research, but clearly the topic has picked up in interest in the public discourse. We've all are getting perhaps amused by the discussions around the Department of Government Efficiency, which has announced significant plans to reduce spending. The question will be very much, is it possible and where should such spending cuts take place? So in the survey we've discussed such a question. You might want to get back to this later on, but essentially we've picked up on two dichotomies in this survey, and one of them I'm sure Mark will have a lot to say about. But essentially, a large majority of our members do not think that the current level of U.S. Spending and finances is sustainable. In other words, it's a rejection of the notion that this can carry on forever. Yet, when you ask those same people whether they think the dollar will lose its reserve currency status, it's the opposite result. A majority do not think that the US will lose its reserve currency status. We call that the TINA effect. There is no alternative, right? And if you remember good old Chuck Prince back in 2009 during the subprime crisis, when he was asked about why Citi was continuing to propose such complex products as CDOs and so on, his answer at the time had been, well, so long as the market is playing music, I'm going to dance, basically. And for the time being, there seems to be no real incentive coming from no particular angle that would act as a clear sign giving the US government its impetus or a need to start reducing its spending in a significant fashion. So it'll be interesting to see what this new Doge department is able to do. Another dichotomy, and I'll end on this quickly, is regional. It is interesting that the responses we got to such questions have differed quite significantly between emerging and developed economies. The clearly emerging markets, developing markets, have interestingly more sanguine view of U.S. public finances sustainability. They seem to be less alarmed by the level of sustainability of public finances than the US themselves. The US is actually where we saw the most pessimistic view on that. But also in emerging markets, this is where we found that respondents were most of the time of the view that the US dollar will lose partially or materially its reserve currency status over the next 5 to 15 years. So lots of dichotomies in there. And again, I would be fascinated to know Mark's point of view on those questions from a historical perspective.
Yeah, Mark, you come at this with a unique view, and having authored just an excellent book about the long history of the financial markets in the U.S., including the origination of government debt under Hamilton, or the setup under the Treasury. So curious to hear your thoughts on kind of where we are today versus, where we've been.
Yeah, so, reserve I mean, I agree with everything that Olivier said, and, the fact is dominant reserve currencies don't change often, so it's not surprising that it's gonna take something relatively extreme to to displace the dollar. But what has tended to happen in history when there are reserve currency changes is some kind of major shock. So the Dutch lost their status when they lost the Fourth Anglo-Dutch War in the 1700s. The British lost theirs, the pound sterling, when after what they essentially bankrupted by not totally bankrupted, but and it's seriously damaged by World War I and World War II. And I think people don't fear the imminent, and I think they're correct, the imminent replacement of the dollar. But the risk is that we're going to have some type of shock, and this is where history, and who knows when and where and what that shock will be. But and this is where history can be a really good guide. And when you know when people talk about the unsustainability of the debt, they're not framing it in the right way. It's the risk of a shock, not, we're projecting this path and we can pinpoint where it's going to be lost. It's the risk of a shock. And this goes back to Hamilton. When Hamilton repaired the debt in 1790, he established two principles. One was you needed sound credit because in times of, quote, public danger, you'll need to fund it, even if you're a wealthy nation. And then he used language in order to render the public credit immortal, you should pay it back once the danger subsides. And we did that for about 150 years. Then after World War II, we were emboldened we had 70% of the world's gold. We had the new dominant reserve currency. Our industrial infrastructure was actually significantly strengthened because nobody could touch us in World War II because of we were separated by oceans and friendly nations to the north and south, while the rest of the developed world was pretty much destroyed. So this really is what emboldened us to shift our perspective away from Hamiltonian principles, and we just ran chronic deficits both in times of public danger and in relatively tranquil times after the danger subsided, and that's been going on for 80 years. And that is really the story of the U.S. use of public debt. I wish we could show on a screen. I do have a graphic that's in the book, and I've published in papers with it as well, that shows the deficits from 1792 all the way to 2023, and you could see you had the War of 1812, huge deficits, and then they're paid back. Civil War, huge deficits, paid back. World War I, huge deficits, paid back, and then World War II hits and it stops, and it's obvious. And when you read yourself to the present, that shift becomes obvious, but very few people are aware of it because we've been living this way for so long.
So has it just become politically untenable to cut programs, or like why do you think it is that it's had this strong march north in terms of the debt to GDP?
Yeah, yes. I mean, that's a general answer, but the big problem is entitlements are the big source of the debt problem, and neither party wants to touch them, but eventually they're going to need to be touched. I just did a recent call with David Walker, who's the former Comptroller General for the United States, and he is pounding the table on this in a bipartisan way. And at the end of the day, he frames it very well. If we continue at current course and speed, I forget the actual date, but within a decade or two, there needs to be a 21% cut. So we can go down that path and go over the cliff, or we can act now and slowly change things like a mortgage that, it's going to be painful, but it'll be tolerable if we do it slowly. And, thus far, politicians have been unwilling to touch it at all. And that is the big source. The one misconception. Now, there are savings in other places for sure. But, one misperception is, that we're wasting so much money on wars. And believe me, we have. But defense spending as a percentage of GDP has actually declined steadily over the last 40 years. That is not the problem. It is entitlements.
Do you mind if I Mark, what would you say it is difficult, and it's the same problem in Europe, by the way. It's difficult to see what sort of political incentive there could be out there for any politician that desires to have some sort of future or career to propose a program that deals with government spending. What's the political incentive there?
You know the problem. Politicians are motivated by short-term incentives to get reelected, which structurally makes it very difficult to address long-term problems that are going to require short-term pain. I mean, that in a democratic society, that is one of the challenges that you need to accept. And there's a great quote from Paul Volcker that really articulates this. I don't have it offhand, but that's essentially the problem. It's the politicians have short-term incentives, and this is a long-term problem. It also explains, by the way, how there's a great book by John Cogan on, it's called The High Cost of Good Intent. And it's a history of entitlements in America. And there's a very, and other countries that address this as well. And there's a very predictable cycle. What happens is you start with a core, like Social Security, and usually around election cycles or during times of surplus, there are people on the fringes that aren't covered, and there's an incentive to expand it.
Yes.
So
Yes.
the bubble just keeps getting slowly bigger and bigger and bigger and bigger. And that's a typical cycle, and we've seen that with Social Security and Medicare and Medicaid and a lot of these programs.
Because if I'm gonna interrupt again your well-crafted program, Mike, but you said something recently during another conversation we had, Mark. You said something along the lines of the fallacy of thinking you can grow your way out of this.
Yeah.
Would you mind clarifying what you mean
So
there?
sometimes I haven't heard it harped on a lot recently, but after World War II, a lot of the reduction in the debt to GDP was a function of the economy was growing so fast. But that was a very different, it was a legitimately anomalous time. We had huge advantages in terms of our industrial infrastructure, our R&D as well. We were extremely wealthy because we had 70% of the world's gold. We had the reserve currency. Plus, I think it was the 1920s to 1970s, roughly that period, we just had this extraordinary burst of productivity growth. Some of that was related to, the necessity of World War II, but some of it was just related to the impact of the inventions. I mean, think about air conditioning, what that can do to the production. You can operate factories, all the time. Electricity, automobiles, home appliances. Think about, washing your laundry by hand. Those productivity enhancements, we underestimate the impact. And it's not that technology has not improved productivity. It has, but it's just, it hasn't been as dramatic. I mean, it's just not in the data. There's a great quote from Robert, I forget Solow, I think is his last name, that talks about just, we tend to overestimate the productivity impact of technology. And the quote is, I have it right in front of me. He's talking about the computing age. What this means is that they, like everyone else, are somewhat embarrassed by the fact that what everyone feels to have been a technological revolution, a drastic change in our productive lives, has been accompanied everywhere, including Japan, by a slowing of productivity growth, not a step up. You can see the computer age everywhere, but in the productivity statistics. So, the argument that we can outgrow the debt is weaker than I think people anticipate, unless there's some type of miraculous boom from AI, which is possible. I'm going to take the under on that, at least in the short term. We probably don't have the same conditions that we did after World War II to outgrow the debt.
And I guess the other lever other than cutting expenditures is, of course, to raise taxes. That was one of the options in Olivier, in your report, that survey respondents were offered, and it wasn't the lowest, but it wasn't the highest take up. Talk a bit about what you saw there.
Well, at the risk of being cynical, I'll say thankfully that was not the number one response chosen by members, but that is, of course, a matter of personal choice. But it is interesting you mentioned this because going back to what Mark was just saying, the top two measures chosen most often by the respondents to our survey were indeed in that order. Number one, reductions in what we call non-mandatory government spending, discretionary spending, right, which comprises defense, but also health and education spending. Essentially, non-mandatory means government programs that have to be decided every year. And so you could make the argument that this is where it makes most immediate sense to make cuts because by definition every budget you could make changes. But nowadays it represents, if I'm correct, less than 20 or around 25% overall budget, whereas mandatory spending is now, if I'm also correct, somewhere between 60 and 70% of the budget. It will be, by definition, um, very difficult to suggest changes to mandatory government spending, which was the second favorite choice expressed by the survey members in terms of how to reduce the debt to GDP ratio. And this takes us back to the point Mark made, because you can also argue that one way to reduce the proportion of your spending to your GDP would be to grow the denominator of that equation, right, which is the GDP itself. And I think when you look at the earlier announced plans of the new U.S. administration, they're trying to play on both parts of the equation. So you want to reduce taxes, and at the same time you want to put forward the conditions for accelerated GDP growth. The question will be whether that um, uh, produces the effect that they would like, but at least they're announcing some desire to rein in spending and by some way, shape, or form. It is interesting as well that another approach here could be to monetize your way out of this, right? Or to generate inflation, which would naturally grow the GDP without having to actually act on the level of spending itself. That has been largely rejected as
Yeah,
a.
that is a dangerous game to play.
Why don't you tell us why, Mark?
Well, it can get out of control. I mean, you could, if you're trying to inflate the debt away and you're increasing the debt at a rate higher than inflation, it's not going to do anything, first of all. And it's just a dangerous game. It can start feeding on itself, and, inflation goes higher.
Your
And,
cost of financing goes up along with it, right?
yeah, that is a very dangerous game to play.
I actually wanted to ask about that as well, what you guys think about cost of capital for the U.S. Treasury. I mean, we had a downgrade last year from Fitch back in 2011. Obviously, S&P downgraded. I feel like the market kind of largely shrugged it off, but I don't know. What do you guys think? Does it not matter?
The downgrade, or
Yeah, the downgrades.
I think the market means a lot more than a Fitch rating. But like I said, it's the at least from my perspective, and history has played out this way. The danger is the unanticipated shock. It's not. We should be fearful of what we don't know, rather than what we do know. I'm sure the British did not, in 1913. They were sitting pretty and didn't predict that, their privilege would be gone within 40 years from 2 world wars. Maybe the Dutch had a little better sense because they knew they were going to war. But these things are the shock is what we're exposing ourselves to, and not being able to respond to it in a way that Hamilton designed.
Right.
Another way of describing this, Mike, is what we refer to as an inflection point. The problem that we're dealing with here is that so long as things seem to be okay, There is this perception in the market that this can go on forever without making drastic change. What Mark is saying is that once you pass an inflection point, the deceleration can be quite abrupt and quick, and it's difficult to identify. That's what we've been struggling with as well here, identifying potential causes for an accelerated rate of de-dollarization. It's difficult to identify a specific shock or announcement or development that will overnight or over a short period of time suddenly create the conditions of an accelerated deceleration or an accelerated rate at which other nations are disposing of their dollar holdings. That is a little bit difficult to speculate over, I have to say.
The two factors that you identified in your report were the one we've been talking about, the inability to service its debt, and then the other being, of course, geopolitical tensions, which
That's right.
Mark touched on there as well. One sort of anecdote that came to mind when I was reading that was just my recent conversation on this podcast with Stephanie Baker, who wrote a great book about Russia's efforts to finance its war or execute its war in Ukraine. And when they, nations around the world went to seize the Russian foreign reserves, and they had almost nothing in U.S. dollars, probably because they perhaps anticipated that they might get seized, which was interesting. You would think a great nation a nation the size of Russia would have pretty significant U.S. dollar reserves, but no, they pulled them all out. Where they did still have a good chunk was in euros, and I know in the report here that was the kind of the biggest potential replacement in terms of people's anticipations around that, but the other was just this idea of a multipolar system. What does that mean, Olivier? What would that look like, a
Well,
multipolar system?
what I find interesting here is that indeed, so we researched this idea. Well, all right. So should the dollar be replaced? What would it be replaced with, basically? Okay, and there's clearly here in our report some parallel established between monetary system, but also just general geopolitics, as you say yourself, right? And when you read political commenting, we've reported on this trend towards what we call diverging worlds, right, or deglobalization, as opposed to a continued convergence and a continued integration of the world. The answer that's been chosen most of the time by the survey respondents in our research here to the effect of what could replace the dollar was this concept of a multipolar currency system, which completely aligns with this notion that we're now hearing instead of a unipolar world centered around an all-powerful West, almost centralized around the US. You might end up with a series of blocks out there, economically well integrated, monetarily well integrated, that will tend to trade amongst themselves as opposed to necessarily depend on global flows, which in turn have been using efficiently the dollar for so many years. So I was intrigued by that. I was not necessarily expecting this. I was also expecting, maybe foolishly, that the some currencies like the yuan would feature much higher in this pecking order. It was not the case. It seems and even in China, there's little people of the view that the yuan constitutes today a very viable alternative to the almighty dollar. What was also interesting is a digital currency, private digital currencies, was the second most chosen option um, in there. So when you think about this concept that people are losing faith in systems and institutions, then maybe that faith will be displaced. And again, I'm using those terms with a lot of prudence. Maybe this faith will displace in favor of a monetary system that is not dependent on political force. But again, that's pure speculation, Mike. At this stage, we don't know. What seems to be earning people's favor is this concept of multiple blocks that are well integrated. But that means that you're going to have to be dealing with a series of currencies that have perhaps equal importance. I think this is a very interesting observation for prospective analysis.
Yeah, this is a hard one to answer, especially because history would suggest that it's going to be a shock that causes if a transition happens, it's going to be some kind of shock, and it's hard to predict what's going to be in the background to replace it. I mean, could some type of multi-currency system be set up and kind of waiting in the wings? And maybe it's a very, very difficult thing to predict. I think it's impossible to predict how this plays out, because usually the shock is an unexpected war. At least the last two were. Could be a natural disaster, another COVID that's worse, or major earthquake, volcanic eruption. Who knows? I mean, people laugh about that. The volcanic eruption in 1815 changed the world. So they didn't know it at the time, but it did. And, it'll be something like that. So it's just so hard to predict what's going to replace it, if that's really going to be the inflection. But I agree that that's a possibility. I think John Maynard Keynes proposed that at Bretton Woods, but Harry Dexter White, would have none of it, and the British didn't exactly have leverage then. So the U.S. dollar became the dominant reserve.
And I guess the best way to prepare for the unpreparable is to have lots of dry powder, or more dry powder, I guess, than the U.S. is sitting on right now.
That is the Hamiltonian principle. I almost want to read the quote because it's so. Do you mind if I read it? We might not use it. The two quotes from Hamilton that really were his two principles for the debt, because if you can work it in, I think it's pretty powerful. Yeah, with regard to public danger, this is it from the first report of the public credit, which was published in 1790. Exigencies are to be expected to occur in the affairs of nations in which there will be a necessity for borrowing, that loans in times of public danger, especially from foreign war, are found an indispensable resource even to the wealthiest of them. It is essential that the credit of a nation should be well established. That was in the opening. And then toward the closing, he said, he, Alexander Hamilton, ardently wishes to see it incorporated as a fundamental maxim in the system of public credit of the United States that the creation of debt should always be accompanied with the means of extinguishment. This he regards as the true secret for rendering public credit immortal. That is what we're violating right now.
Well, that's a great way to finish us off, Mark. I've been speaking today with Olivier Fines, CFA Institute's head of advocacy and capital markets policy research for EMEA, and co-author of a recent report out of the Institute, The Dollar's Exorbitant Privilege, CFA Institute Global Survey on the U.S. Debt and the Role of the U.S. Dollar, as well as Mark Higgins, author of Investing in U.S. Financial History, Understanding the Past to Forecast the Future. Thanks to both of you guys for this great conversation today.
Thank you. It was a pleasure.
Thank you, Mike. Thank you, Olivia.
Thank you as well.
I'm Mike Wahlberg, and this has been The Enterprising Investor.